Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is Getting Started with Options. And yes, it has been a crazy last couple of weeks on the market. Stocks are going all over the place. So what I wanted to talk about today is a kind of not terribly common sense strategy, not entirely intuitive strategy, but this is one that some traders will use when they think stocks are going to be moving strongly in one direction or the other. What we're actually going to be doing today is placing an example trade, buying a call and buying a put at the same time, let them duke it out for sort of long option supremacy. It's an interesting strategy. I think somebody could chat in right now and let me know what strategy am I talking about. But before we get to any of that discussion, let me first of all say hello to everybody who's already joining us out there in YouTube. Great to see so many familiar names, a couple of new names out there as well. Hello there, Janelle and AL, Andrew, John, Will, AJ, Eva, Tatiana, and everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series. Kicks off promptly at noon Eastern Standard Time. We'd love to have you here in the live discussion if you'd like to join us. I also want to let you know that my very good friend Connie Hill is going to be hanging out in the chats with us. Connie's going to be addressing any questions that I can't get to just during the flow of the presentation. Thanks for being there, Connie. And Connie and I would also like to issue an invitation to everybody watching. Follow us on X. You should be following your favorite presenters there on X. If you have an account with X, give us a follow. You can follow Connie there at Connie Hill CS, and you can follow me there at Cameron May CS. But let's get right into this discussion. Ron and Andrew both say strangle, which, yes, could describe what we're going to be talking about. Tanya P, yeah, we're going to be talking about a straddle. It's very similar, essentially the same strategy depending on strike selection, straddle, strangle. But before we can get to that, let's first of all consider the risks associated with trading. Risks are real. They certainly apply to options, especially when you're doubling up and doing twice as many options. Yeah, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so let's talk about what we're going to talk about. Agenda for the day is to take a quick peek at the markets. Markets have been up, they've been down, they've been back up again, and that market discussion is going to set the stage for today's strategy. Yeah, with that much volatility in the markets, there's one strategy that some traders will turn to in these sorts of environments when they think markets are going to go strongly in one direction or the other. Stocks are likely to go strongly in one direction or the other. They just don't know which direction. So we're going to be talking about something known as a long straddle. Yes, a close cousin to the strangle strategy. We're just not going to be talking about that one today. But in any case, we're going to be talking through the pros and the cons of this strategy. We're going to be placing an example trade, talk about how it might be managed after that. Okay, so let's go right to the Thinkorswim Paper Money platform. So here's what's been going on with the S&P 500. I don't think this is going to be a huge revelation to very many people watching this right now. Markets have been all over the place, especially starting right back here. We were already really moving down since that February 19th high. Came down about 10.5%, recovery, and then we started to fall. And really over the last week in particular, from the highs of the 2nd of April to the lows of yesterday, that was about a 15% drop on the S&P 500 accomplished in 4 days. That's a ton of volatility relative to what we'd normally see over a 4-day period. Unfortunately, that's the equivalent of giving back at about an average year and a half of performance across an investor's portfolio. That's how volatile it is. Now, since yesterday's lows, we've actually rocketed back up. And from yesterday's low to today's high, about a 9% recovery. Now, we've surrendered some of that. And there was something interesting about the proportions of this volatility that kind of caught my eye. We'll see where it goes from here. But for some traders, when they see a really strong move in one direction or the other, like back here, we saw a strong move up. In this case, we're seeing a strong move down, but it's quite common to see a counter trend move, a counter move of about half that distance. I didn't even measure this one before, but let me just quickly employ a drawing tool known as the Fibonacci retracements tool. I'm going to click on that. This strong advance back here from the 1st of August to, what was that, the end of August? I'm going to click at the top of that and pull down to the bottom, and pretty much as I suspected, we had a strong advance and then gave back about half of that. You'll notice we pulled back about 50%. Well, let's see if we're seeing similar proportions here. A strong sell-off, this 15%, if I go to the bottom of that and click up at the top again, look where today's candle hit its peak. Yep, we've seen a 50% recovery off of that 4-day low. So it'll be interesting to see where this goes from here. I think that there are some technicians who would look at this and they'll say, well, obviously, Cameron, that means the S&P 500 is going to go down. Well, it certainly could. Or there might be some who think, well, maybe this is more like those COVID lows that we saw on the markets, and we just kept rocketing up to the upside. In either case, if we're expecting an explosive move down, maybe we ought to buy a put. If we expect an explosive move up, maybe we ought to buy a call. Well, is there anything in the options trading rule book, let's say section 2, sub clause 3, that says, hey, you can't buy a call and a put at the same time? No, actually, the trader can, and that creates, depending on strike selection. I know somebody chatted in there and said, yeah, Tanya P says, using the straddle is using the same strike, a strangle is using different strikes. Exactly right. Let's focus on one strategy today so we can learn it more thoroughly. Yeah, but there's nothing that says that we can't just buy a call and a put and sort of let them duke it out. And I know when I first heard about this strategy, that doesn't make any sense. If you buy a call and the stock that you buy it on goes up, then you make money. But if you own a put at the same time, that loses money. Isn't it a wash? And if the stock goes down, maybe you make money on the put, but if you own a call at the same time, that loses money. And isn't that a wash? That's a possibility. But it depends on the size of the move and the trade management. So I'm going to right click on this. Let's just clear off this drawing. In any case, yeah, there's our unpleasant review of what's been going on with the S&P 500, but volatility is big right now. And so today's discussion, we're going to lean into that, and I want to build a trade around a stock. Let's say the trader is looking for a stock that's doing something similar, also moving around in big jumps. And what I want to look at today, we're going to use Bank of America because in the spirit of leaning into that volatility and building a strategy around volatility, maybe sometimes the trader might even want to dial up that volatility. How might we dial up volatility when it's already there? Well, we might look for events on our calendar that tend to inherently carry additional volatility, such as an earnings announcement. Yep, we're going to be trading in this highly volatile environment on a highly volatile stock at a highly volatile time around earnings. And it's that volatility that can ultimately determine the success or failure of this trade. Now, if we were confident, let's say that our trader just saw this downward trend on Bank of America, and they thought, you know what, I think that earnings is going to go poorly as well, and I think it's just going to accelerate the selling to the downside. Might they just buy a put? We've learned about puts. We learned how they can make money if the stock goes down sharply. Yeah, we might just, if we had some perfect insight into an earnings announcement, which, spoiler alert, nobody has, maybe we just buy a put. Or if we thought, well, this stock is overdue for a pop to the upside, we could get one of these events like we had on this earnings announcement, or one of these events, this big gap up here on this earnings announcement. A big gap up if we own a call. Ooh, a call carries actually unlimited upside potential. Well, in this case, we are going to go construct a straddle and just buy both. Janelle says volatility is your frenemy. Yeah, Janelle. Interestingly, this is a strategy where the worst case scenario is that the volatility stops. That's the worst thing that could happen to this strategy. So we're leaning into volatility, and if we don't get it, that could be disastrous for a trade like this. But here's how we're going to map this trade out, and then I'll just explain how it might work. And we're going to talk about maybe a sort of counterintuitive way that we're going to plan to manage this example trade. Let's go to our trade tab. I'm going to go out to an expiration beyond the earnings announcement. In this case, our earnings, if we look at it here on our chart, is right there on April 15th. So if we want that to play a role in the ultimate outcome of this trade, we got to make sure that we go out beyond that earnings announcement. So let's go out at least April 15th, and we're going to go out to May. Let's go out to the 16th of May. We're going to be giving this stock some time to move, either just in response to current market volatility, to what we all know is happening globally, or more locally, what happens to that earnings announcement. So we're going to go to the 16th of May. And with the stock trading right around $36 at this moment, I'm going to focus on the $36 strike price. And here is going to be our trade. So let me pull this down here, make sure that I don't obscure your view of what I'm doing with my camera shot. But our example trade, let's make it bold. Example, let's try that one more time. Our example trade is going to be known as a long straddle, and I'll talk about that terminology so you understand where the language comes from. But really, all it is, sometimes the strategy is it can be kind of complicated. Other times it's relatively more straightforward. A long straddle simply means that we pick a stock, we pick an expiration, we pick a strike price, and we buy a call, we buy a put at the same strike price. So that's what we're going to do. We're going to buy the 16th of May $36 call, and that looks like that's trading between 237 and 240. Let's just say we pay 240 for it. And at the same time, we're going to buy the 16th of May $36 put. And that's trading between 203 and 206. I'm going to use a nice round number. We'll go 205. All right. That means the net cost of this trade, which is also the most the trader can theoretically lose, because if they make the investment and the trade doesn't work, they can, with this strategy, lose it all. Okay? But the theoretical maximum loss of this trade is going to be the cost, which is $2.40 plus $2.05, buying the call, buying the put. That's $4.45. So as we go into this, I want to lay out some ground level expectations. This is a trade that actually carries with it unlimited reward potential. That's because we own a long call with this, and if the stock goes skyrocketing up, the higher this goes, the more money this long call can make. The markets, let's say all the global tensions are eased in the next week. And let's say the earnings announcement the earnings are spectacularly good, way more than anybody could have ever expected. And the stock rockets up, triples in value, goes to $100 a share. Well, hey, this call gives us the right to buy shares for $36 per share. You can see that would be, what, a $64 discount from the current price? Is that going to happen? Almost certainly not. But that call has unlimited upside potential. The higher the stock goes, the more that call can make. Well, at the same time, what would happen to this put? Well, it would just get massacred. It would lose its full value, most likely. So we have a call that's worth $64, a put that's gone from $2 to $0. Hey, that's still a pretty good profit. To the opposite extent, if the stock collapses, we can make a lot of money. Not unlimited, but it can make a lot, because if the stock falls, well, hey, we have the right to sell shares at $36 a share. So if they're worth less than that, we have an advantage over current market price. But the further the stock falls, of course, our call can lose money. But what we want out of this trade is an explosive move in one direction to the other. If we don't get that explosiveness, if the stock just sorts of wheedles along, doesn't leave its $36 launching pad, Well, guess what? There's no advantage to being able to buy the stock for $36. There's no advantage for being able to sell the stock at $36. If that's what it's worth to everybody else in the marketplace, that's where we could lose the $4.45. So the worst case scenario, we do not want the stock to go sideways. I think you can see why this is a trade that leans into that volatility. If we go skyrocketing up, awesome. If we go plummeting down, great. If we stick sideways, worst case scenario. So how much can we make? Well, I've already mentioned the theoretical maximum gain here is unlimited. All right, so I'm going to hit the pause button on the discussion there for just a moment because there is a request that I have of my live audience right now. I just noticed that there is a survey link that's been added to the chat stream for the live audience members. And so do me this favor, if you would just quickly click that survey link. You don't have to fill the survey out right now. As a matter of fact, it would be premature because I'd like some honest feedback at the end of the discussion. Tell me how it went. But our surveys are really short, 2 multiple choice questions, and there's a comments box and a suggestion box. What I'll say is if you take that tiny bit of time to fill out my survey, I always read through that survey data. I look at how everybody answered the 10-point scale of how well I did. I also read through the comments. So it definitely always helps. It's never a wasted effort, okay? Okay, Ambrose, you're getting a little bit ahead of me on this. So Ambrose just proposed, well, Cameron, what if we just sell a call to pay for the put? That would be a different strategy. Maybe I'll get to that in the future, but in this webcast series, it's called Getting Started with Options. And so I kind of have to strike a balance with how fancy I get with these strategies. But I think we're at a comfortable level here where we know, okay, if we buy a call, we understand the obligations and the risks of that. If we buy a put, we understand the obligations and the risks of that. We're starting to build these combination strategies. We already built 4 combination strategies in my lesson series. So this one I felt all right about. Going a little bit further than that, or maybe we're doing 3-leg strategies or 4-leg strategies, I think that might start to push us outside the scope of this webcast series. So legitimate question. It just might be a little bit above the level of this webcast series. Okay? But by the way, I do have a recommendation because I just mentioned we built 4 combination strategies. I don't remember that, Cameron. If you weren't here to see that, let me show you. I have a recommendation for everybody right now. If you haven't subscribed to our Trader Talks channel on YouTube, do that now. You can go right down below the video stream, click on the subscribe button. It just takes a second. It doesn't cost anything. Don't click on it if you've already clicked on it in the past because you're already subscribed. But yeah, if you haven't subscribed, click on that subscribe button. But our YouTube channel is where we keep and publish all of those other webcasts that we've already done in the past. And we publish those in playlists according to the series. So my series, Getting Started with Options, we could go to the playlist right here. So specifically, to find yourself where I am right now, you just go to YouTube and just do a search for Trader Talks Schwab Coaching Webcasts. Or if you've subscribed, you can just go to your subscriptions page and you'd find us there. But go to playlists and then just scroll down. And you'd think you'd actually be looking for my face. You're actually going to be looking for Barb's face down here at the bottom because she used to teach this webcast series. Getting Started with Options. Click on the View Full Playlist. And I went through a series of 10 lessons to bring somebody along who's new to options trading, just starting with the basics. What are options? What are the basic options types? And then we use those as building blocks to get into some of the fancier strategies. So you'd want to start with lesson 1, go to lesson 2, lesson 3. But as we moved up in these lessons, we started to getting into these combination strategies. Long call spreads, long put spreads, short call spreads, and so on. So there you go. Yeah, Dina says, I'm so new, I don't even know what a call or put means, so I think I need a beginner course. That's exactly these lessons, Dina. So glad you're here today. By the way, hang out, watch the rest of this webcast. I always try to go at a pace, hopefully, that everybody can follow. Even if you get, a relatively small percentage of what I'm talking about, I think there's still learning that's accomplished there. Yeah, I would just start right there, lesson one. I start with what long calls are, and then what long puts are, and short calls and short puts. So yeah, everybody started in the same place, Dina. I can relate. Okay, so let's get back to this somewhat counterintuitive strategy that we're outlining here. Hopefully, you can kind of, really for any strategy, as we talked about those combination strategies, the real key here is for the trader, as they're getting a little bit fancier and they're combining different strategies, break it apart again. Just remind yourself, okay, so if I do buy a call, what does that mean again? I'm spending $2.40 per share. That's $240. So what do I get for my $240? Well, for the next 38 days, or through the 16th of May, that means I have the right to buy 100 shares of Bank of America at $36 per share. All right, so if Bank of America goes up, oh, look at that, it's exactly 36 bucks right now. This is just about the ideal scenario for this discussion. Anyway, yeah, if the stock goes up, I've locked in a purchase price of 36. If the stock goes down, that's where the put comes into play. I spent $2.05, and in exchange, I have the right to sell shares for $36 per share. One of those can deliver a great advantage over market price as long as the market price is substantially different sometime in the next 36 days from where it is right now. So let's go to our charts, and I want to draw in a line of reference right here. Let's use our drawing tool. Drawing a line right at 36 bucks. That's right there. You can see how close that is to where we are right now. That's going to represent our straddle there. Now I'm going to draw in a couple of other lines because these are going to be really important if we hold on to the whole position and allow it to go all the way to expiration. These are going to be our break-even lines. If I spend $4.45 and then this stock doesn't move at least $4.45 as of expiration, we didn't even break even on this trade. So where's $4.45? 36 plus 445 would be up here at 40.45. Let's draw a line up there. This is really going to drive home right up there. That's 40.45. And then $4 below this is going to be down. I might even have to drag up my scale here. I don't know if you knew you could do this. You can come over to this y-axis, click on it, and just drag it up or down. Play around with it so you can see how it works. But I'm going to drag it down here and draw in a second line that's $4.45 below 36 bucks. That's going to be, what, 31.55? That's going to be right down here. Make sure I get that as close as I can. I'm gradually moving up that scale. That's close enough. Those are kind of the break-even points through the next 38 days. Let me just read the chats here. I think somebody just, okay, good. Ray says, you got the sound resolved. William says, in this crazy market, is it possible to make money on both the put and the call? William, actually, we're going to attempt to do that. Yep, it's possible. Is it likely? No, this is not a strategy that is high probability. It's not. I said we want to set some foundational expectations for this strategy. A long straddle like this is a low probability strategy. So what I want to talk about here, let's first of all talk about why do we call it a long straddle, and then we're going to talk about why it's not inherently a high probability strategy. As a matter of fact, it is inherently a low probability strategy. Why would anybody trade it? Well, because it carries such massive reward potential. Most of the time with this strategy, the trader is going to incur a small loss. That's the way it usually goes. Small loss, small loss, small loss, maybe a small gain, small loss, small loss, small gain. Strategy where we're kind of floating below water. Nose is going underwater a little bit. And then all of a sudden, we get the explosive move on one of these that we were expecting, and it makes a lot of money. That's sort of the life of a typical straddle trader. So why is it called a straddle? Well, if we look at our option chain, we have 36 in the middle. We bought a call on the left side here. We bought a put on the right side here, we're kind of straddling the $36 price. That's the way I think about it. It's kind of like when you get into the saddle of a horse, you put your left foot in the left stirrup, you put your right foot in the right stirrup, and you straddle the horse. Yep, in this case, we're straddling the $36 price. It's referred to as a long straddle because in trading terms, when we say long, it means that we bought something to initiate a new position. Like if we buy a stock, as routine as that sounds, we would actually say that it would be correct to say that we are long that stock once we had bought it. If we sell something, we're short that thing. So this is a long straddle. All right, so let's go back here to our chart. Why is it low probability? Well, we've learned about this thing called time decay. Each day that goes by where we're not getting the result that we expected, time can chip away at the value of this position. And time is predictable. Time goes by. Matter of fact, I have a book sitting right by my right on my nightstand right now. I'm reading through. I don't know if anybody else is fascinated by physics and astronomy and astrophysics. So I'm reading a book about Albert Einstein. And yeah, I actually am learning about time. Interestingly, time is relative. Anyway, for an options trader, it's sort of the one predictable element of a trade. And predictably, the value of these contracts is going to go down the less and less time we have for the stock to do something. Because of that, it creates a low probability scenario because we have time fighting against us. Doesn't mean it's an impossible to make money scenario. It's not what I said. Because if we do get a strong move up or down, this trade could actually do just fine. And going back to William's question, is it possible to make money from both? Beauty says, should we consider delta when selecting a strike for this strategy? Beauty, typically, not always, typically you just go at the money. So delta is not really, it would just be a 50 delta. But it's easier for me to just say, look at the current price of the stock, and the typical straddle would be done at that price. Now, we could go to some other strike price if it was further away, like let's say we went with the calls. Well, that would give us the right to buy the shares at a higher price than they're worth. That's actually going out of the money. But the puts, we'd be able to sell at a higher price. The puts would be in the money, so we would be spending more on the put than in the call. It creates a bearish bias for the trade. So, or the inverse would be the case if we went to a different strike. But normally for a balanced straddle approach, we just choose the strike price that's closest to the current price of the stock. So the strike selection actually is one of the easier things to do on this strategy. All right, but I do want to go back to William's question. Is there a scenario where the trader might make money on both? Yeah. Well, for some traders, they actually might just put this trade on and essentially cover their eyes. They might say, I'm willing to lose the whole $4.45. That's the maximum risk of this trade. But there may be no plan at all for the management of this trade. They're just going to pop their head up out of the sand on expiration day and see what happened. So what could happen? Let's talk about that. I think that there are about 5 scenarios that could happen. There's one that's extremely unlikely. And that's the scenario where we happen to be at exactly $36 at expiration. We lose the $4.45. So even though I say that we could lose $4.45, there's almost no chance we lose all of it. What would have to happen to lose the full $4.45? Well, we'd have to be at exactly $36 at expiration. If we're even a penny above or a penny below, there's still some value in our straddle. So let me talk through that most unlikely scenario first. If we're at 36 bucks, let's just say the stock is at $36 right now. It's actually 5 cents above, but it just goes sideways. And we wind up right at $36 on the 16th of April or May. What happens there? Well, the stock's worth 36 bucks. we have the contractual right to buy it for 36 bucks. Well, who cares? So can anybody else in the marketplace. That has no value and we lose our 240. At the same time, we also have the right to sell shares for 36 bucks. Who cares? So does everybody else. We could just, without any contract at all, theoretically, we could just go sell a stock. We could sell shares at 36 bucks because that's how much they're worth. So that contract has no value either, and we lost both sides. Lost our 445. Well, what if it's not at 36? What if it's gone up a bit? Let's say it's gone up a little to $38. So we got some volatility, just not as much as we expected. Well, we're going to lose some money. We're not going to lose all of it, though. So for some trader, if a trader is thinking, I'm willing to lose up to 445 on this, the reassuring story they can tell themselves, and it's mostly a true story, is that they're probably not going to lose the whole 445. What if the stock goes up to 38 bucks? Well, we have a contract that says we can buy those same shares for $36. That's a $2 discount. So that still retains value. It's worth $2, not 240 anymore, but still $2. At that moment, we also have the right to sell shares for 36 bucks. Not a great deal. The shares are worth 38. We have a contract that says we can sell it for 36. So what? Allows us to sell the shares for less than they're worth? There's no value in that. And we lose the 205. So we have $2 of value in the one contract, 0 in the other. That's still $2. So we lost about half. That's not what we want, but actually representative of a fairly common outcome with this. That's why I say with this sort of a trade, if we don't get a strong move up or down, the trader's usually going to lose a little bit of money. But in the times when they get it right, they can make a lot of money. So let's talk about another scenario. What if the stock goes down? Let's say it's down here at 34 at expiration. You get some volatility, just not a lot. Well, it's not worth anything to be able to buy the shares for more than they're worth, so we lost the 240. We do have the right to sell shares for more than they're worth. We can sell a $34 stock for 36. That's a $2 value. We have $2 remaining in that scenario. Spent 445. It's worth $2. That's not what we wanted, but it's not a total disaster either. Well, what if our other two scenarios happen? We get a strong move up or a strong move down. Let's say the stock goes rocketing higher. It's up there at 44 bucks at expiration. We have the right to buy shares for $36. It's worth 44. That's an $8 value that we only spent 445 for. In that case, we're looking at a pretty solid return. Or if the stock goes down, let's say it's down here at 28. In that case, we have the right to sell shares for 36 that are only worth 28. That's an $8 value. We paid 445 for that net. That's a pretty solid return. And really, the further this goes, the bigger those outcomes can be. So our straddle traders, if somebody bought a straddle back here, just envision this. Envision we were in this trade right here. We were worried it might go sideways, and then it collapses like that. That's what we're looking for. Or if we bought a straddle here, or if we bought a straddle here, or if we bought a straddle up here, yeah, that's what we want. One of these big moves. So there's should I call that the straddle fan there? But I like how it actually creates an arc the way I've drawn these. That was actually not anticipated, but anyway. I think we get the point here. But that's if we hold till expiration. Let me just clean this up a little bit. Let me remove this drawing. Let's leave these two on. Is it possible that we start to get a nice move up before expiration? Or is it possible, let's activate this drawing, that we start to get a nice move down before expiration? Yeah. So this is going to your question, William, the whole point of this discussion I want to have. If we get a really nice move up, this call could be sitting on a decent profit very quickly. Or if we get a nice move down, this put might be sitting on a decent profit very quickly, unrealized until we close it out. So if our stock, if we're expecting that it's going to chop around, what some traders will do is they have no bias. What they're just going to do is watch this along the journey to expiration. And if we get a strong move in one direction, take the profits on the profitable trade, on the profitable side of the trade. At that point, let's say the stock moved up sharply and we quickly take the profit on the call. Well, now we're just left with a put. That put that we spent $2 on. So maybe we've already realized a gain on the call, and now we're sitting on the original investment on the put that has already been partially paid for by the profits on the call. And then we just see, well, maybe the stock, as it's chopping around, chops back down and presents another opportunity maybe to reduce the losses on the put, or maybe even take some gains. That's a possible outcome, William. And that's the way some traders will manage this trade. What we're going to do with this trade, we're going to keep an eye on this earnings announcement. And if we get a pop in one direction or the other, we're going to take the profits on, if we have a profit on one side or the other. I always have to qualify it with an if. If it's not a strong enough move, it might not be enough to generate a profit. But if we get a nice move on that earnings, we're going to take the profits on the one side and see if we can get a retracement on the other side. But that turns this into a much smaller risk scenario when we do that. Because we will be out of one side, it's no longer be at risk, hopefully already profitable, and then we just need to see if we can recover some value or maybe turn into profit territory on the other side. So a little bit more complicated strategy, but this is an introduction to what's known as a long straddle. Let's go put it into practice. Tucson says, so Eagle Eyes to move to exercise the option. Tucson, so these are both long. There's no threat of early assignment. We're not selling anything here. We're not in a short position. And the trader would have the option. They could have the choice to exercise, but generally speaking, I say generally, and then I'm going to extend that. The vast majority of the time, exercising before expiration is not in the best interest of the owner of that long option. I'll just say that. Okay, it's not usually the mathematically best exit. Usually the mathematically best exit, rather than exercise, is to sell a contract that's going well. Okay, but let's go to our trade tab. How do we put this trade into practice? There are a number of different ways that we might do this. One quick way is to come up here where it says spread single and just change that to straddle. And that just pairs up all the strikes. When it says 36, 36, what that means is that if I click on the ask price, this is now going to create an order. And notice I could click on the ask price over here on the puts. I could click on the ask price over here on the calls. They're exactly the same because this is now preparing to buy a call and buy a put at the same time. So I'm going to click on that. That creates a straddle. For this trade, let's just do one contract. Now, you can see it says plus here. You can't actually see the one. It's because it's a little bit squished there. So whenever you can't quite see things, you can come up to the little margin in between the two columns, and you can drag that back and forth. In any case, yeah, we're going to be buying a call at 36. We're going to be buying a put at 36. It looks like the cost has gone up, which is a good thing for the people that bought back here when it was $4.45, because now they might be able to sell for $4.60. The value is already changing. But let's say that we're willing to spend now. That might cost us, I'm going to say, you know what? I'm going to say that we're willing to spend $4.65. Yep, it's going to cost us a little bit more than we had originally calculated. It's going to be a limit order. Let's click confirm and send. Buying this one straddle at $4.65. That's a $465 loss potential. We're almost certainly not going to lose all of that. There is an infinite profit potential because of the ownership of that long call. There is a commission to be paid here, and I'm going to send that order off. Now, as we do that, let's see if we can get that filled. Yep, we bought that for $4.64. So our break-even points are going to be slightly wider than what we originally calculated. I want to have one more thing here that we talk about. Actually, let's clear this drawing set off. And I want to make a quick note. Let's see. Let's put a text note right down here next to this earnings announcement. There we are. Sell profitable leg after earnings. So that's sort of plan number one. But also number two, exit, let's say, remaining leg before expiration. There we go. Let me activate this and move this up a little bit. I'll put it right. Yeah, it's okay. I'll just leave it there. That's fine. In any case, this is just a reminder of what we were already planning to do. This one, exit the remaining leg before expiration. Why? Well, because this is a long contract. If, let's say, we still owned the call, let's say the stock fell on earnings, we sell the put, we take a little profit there, and we hang on to that long call all the way to expiration, forget about it. That contract will be assigned if it's still in the money at expiration, or if it is in the money, it would have to recover to get in the money. In any case, if it's in the money at expiration, it could be assigned or exercised, and we wind up buying 100 shares of stock that we didn't have any intention of buying. So, yep, we still got to keep an eye on that on that other leg. Joseph says, ideally, wouldn't you want to place your trade as close to earnings as possible with a short days till expiration? That, I was tempted, Ron, to get into that. I thought that might be a little too much. Maybe we'll revisit this strategy in a later webcast. There's always more to learn, isn't there? There's always a little refining that a trader can do in their understanding of a strategy. And the timing before an earnings announcement, I think, merits its own discussion. So I'll do that later. Okay, Ron, it's a good question, though. Anyway, we've done it. We're in a long straddle. So we'll see where this goes from here. It'll be interesting. But everybody, we've taken a look at today's market conditions, volatile market conditions. What's a strategy that some traders might employ in such conditions? Well, this is one of those that some might consider. So we've talked through what a long strategy is. We've gone through how it might work, how it might fail completely, and we've even placed an example trade with a plan for the management of that trade going forward. So now we'll let the markets decide. Do we care which way? No. If the stock goes up, great. If the stock goes down, great. If the stock goes sideways, not good. Eva, hey, thank you for watching. You're welcome, Andrew. Thanks, everybody, for giving me your time today. I'm going to let you go enjoy the rest of our webcast for the rest of the day. But as you go, a couple of quick reminders. Number one, we've already mentioned this, but if you haven't subscribed to our channel, make sure that you pop down, click on the subscribe button down below the video stream right now. That'll subscribe you to our channel. But our Trader Talks YouTube channel is where we house our previous webcasts that we've already delivered, so you can go look through them according to which series is intriguing to you. You can also join our live streams right here. Also, make sure that you're following Connie and me and your other favorite presenters on X. So Connie can be found on X at Connie Hill CS. You can find me on X at Cameron May CS. And this is where I can go when I have something to talk with my internet friends about. This is how I connect when I'm not doing a live stream. And I'm only doing a live stream 45 minutes each day, 5 days a week. That's what, 4 hours and change? And I'm actually doing a live stream. It's less than that, 4 hours. Anyway, but this is where you can get observations. I actually posted this chart, asked a question about it, and a link to a possible answer. A YouTube video that I made previously about something called Elliott wave theory. So you might want to go check that out. Anyway, yeah, follow us on X, subscribe to the channel, fill out that survey if you would. That would be fabulous. And also thank you to everybody that's already clicked the like button. The thumbs up on YouTube is like applause to your presenter. It also gives a boost to the webcast. in the YouTube algorithm, so it helps more people find our webcasts. And I can see that there are 68 people who have already clicked the thumbs up or the like button. Thank you. Appreciate that. Everybody, go enjoy the rest of your day. I will see you again next Tuesday. Of course, I'll also look for you in my other webcast series, something new every day of the week from me. So just look for me on the calendar. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.